Now, the changes, of course, in the budget came about because holiday lets are lucrative when it comes to tax benefits. If you're in the mortgage market, or you're going to be, and you're very familiar with landlords who buy property under a buy-to-let mortgage and rent them out to somebody for 6 months, 12 months, 2 years under a short hold tenancy, you know full well that the tax benefits of doing that have gradually been eroded over the last few years. And a lot of the smaller landlords are pulling out. In fact, the Chancellor reduced the capital gains tax for high rate taxpayers selling property, second property, last week, which might help a few come out if they want to. So I'm not sure if that's going to work or not. But on the other side, we have had a number of landlords looking for maybe different places to rent their property, and they've looked at HMOs, which are houses with multiple occupation. Think student houses, with loads of bedrooms, to make extra money or to increase the yield that they have when investing. But many of them during the last couple of years have migrated over to holiday lets because of the tax advantages. So I want to talk about these, how they currently stand, and then what the changes are coming in as well, just to update you as well. Now, to help you, I'm going to give you a little case study, which I've created earlier, which is just a bit of fun, isn't it? Now, the case study that I've got for you is a fictitious, by the way, Gareth and Sian, who've inherited this property in Tenby in Wales, which is a beautiful part of the world if you've ever ventured down there. It's gorgeous down there. You don't have the crowds down there either, which is fabulous. Maybe in Tenby you do, but along the coastline there, in the Pembrokeshire country park or national park, isn't it? They're absolutely beautiful. Anyway, they've got themselves a gaff which they've inherited, and they've inherited it from the granny who died. And this property in Tenby, they inherited in 2019. Let's get the dates here for you. In 2019, and it was worth £200,000 in 2019. Now, because it was already a property geared up for rental to holiday makers, it qualified as what they call a furnished, here you go, furnished holiday rental, or holiday let. Doesn't matter what you call it really. But because it's designated as a furnished holiday rental by the local authority, then it gets lots of benefits. I'll talk about this in a second. But it's furnished. It's got furniture in it. And it's available to holiday makers to go down there and have a good time for a week or two and enjoy themselves. Now, the benefit of doing the holiday rental as opposed to a normal rental for short hold tenancies is you get some tax benefits. And there's lots and lots of tax benefits available. In a sense, you are designated as a small business. Now, you own it on your own, so Gareth and Sian own this as a sole trader. So they are a sole trader or business partner. It doesn't matter how they decide to own it. It's not an SPV, which is your limited company that a lot of landlords are doing now. So it's owned individually. But there's lots of benefits. It's treated as a business. So, all your mortgage interest you can deduct from any profits that you make. You can't pay tax on the rent, of course. So all the mortgage interest is covered as well. You can have all sorts of costs to buying white goods and improving the property as well, furnishing it. You can offset all those costs as well. The council tax is not applicable because you're a business, and because your money is below the business rental figures, there's no business rates to pay. So, it's pretty advantageous in that respect. Now, we're not talking here about holiday homes or second homes that somebody has down there and they switch off the electricity and they go back every now and then and they visit the holiday home. We're talking here about full-time holiday rental properties. Very rarely are they ever used by the occupant or the owner of the property. It's a very different concept. But because you get all these tax benefits, HMRC have a number of rules, naturally, which they use. And I call this the 105, sounds like a sort of a train directory, isn't it? The 210 and the 31 rule. And these are very explicit, and the HMRC will check these. As soon as you've registered as a holiday let, they want to make sure that it is a holiday let. So it has to be available, if you like, for 210 days. It must be advertised and available to rent on a website somewhere for 210 days. That's that's 2/3 of the year. So it's not a second home, you see, because you want to be renting it. The 105 is the number of days you've successfully rented out the property. Now, that's a big thing. That's a third of the year. So that's going to be like the prime times, like sort of, May, June, July, August, September, October, aren't they? Maybe Christmas time as well. So if the owner wants to live there for themselves, they'll have to go down there in November or February or something like that. But the good ones, of course, use local agencies to do the marketing as well. Now, 31 is the maximum days you can stay at one of these rentals. So it's not a short hold tendency. When we went down to Cornwall in January, because we were having some building work done here, we rented a holiday let for 2 weeks. Good price too, because January nobody wants to rent holiday lets. But of course we couldn't have rented it for more than 31 days. We didn't want to. We were there for 14 days. So these are checked. This makes sure it's a proper holiday rental. As a result of that, all the costs of running that business can be offset against tax. And it's really, really quite lucrative. There's not just the income tax where there's benefits, also the capital gains tax, which I want to come on to in a second. Because this couple who own it have decided that they're going to sell the property. Now, what do? Now, first of all, Gareth is a builder by trade, so he decided to build an extension on this property. There you go. So there's the extension there for you. It looks like a church, doesn't it? So he decided to build an extension here with a terrace there at the top to catch the sunshine. There's your sort of gate there, terrace. So he built this this extension himself. Now it costs £50,000 to build that, and remember the property was originally valued at 200,000. So that's the situation. And he and Sean, they wish to sell it in 2024. There you go. They want to sell this, and they've got it on the market, and they're hopefully going to sell it for £400,000. Because they're moving on, they want something different. So it's done okay, in 5 years. But obviously the extensions help to increase the value. But holiday rentals, of course, this is the reason why the government changed the rules, is because loads of properties in these little towns, by the seaside especially, are so expensive, local people can't afford them. I mean, 400 grand for a 2 or 3 bedroom property is a lot of money. That's like Cheltenham prices, rather than South Wales prices. So that's the issue. But anyway, we'll get on to politics later. The question is, though, how much is the capital gains tax? CGT is the issue. We talked about income tax briefly. Let's take a look at CGT, because you've got this thing called business property relief. I want to talk about this now. I'm going to go to some slides to share this with you. And remember, this is kind of all changing, although the asset relief won't be. So let's pop over to a slide for you so we can give you some details about this one. Here we go. Let's pop this up for you. So capital gains tax on furnished holiday lets is what I'm referring to here. Let's pop me up the top corner. Actually, let's go down there. I'm in the way here. It doesn't matter. CGT on furnished holiday lets. You're talking here about business asset rollover relief or business asset disposal relief, or BAR or BADA as known as. Now, why we got these names, I don't know. Here's a quick Trivial Pursuit question for you. Which artist, who's the artist formerly known as? Who's the person involved here? But you're guessing. Which artist, who actually called themselves the artist formerly known as? Of course, we're talking about Prince there. Prince and the Revolution, brilliant artist, of course, very good. But the one that is formerly known as business asset disposal relief is formerly known as entrepreneurs relief. And that's the thing, because when you're talking about property, business property, if you are to dispose of it or roll it over, you can enjoy some tax benefits on capital gains tax. And it was formerly known as entrepreneurs relief. Why do you need to know that? Well, you might have read an old book which has got the old thing in it. But it's business asset disposal relief. So how do these all work then? So let's take a look at the rollover relief first. Then we'll look at the disposal relief. And then we'll talk about the costs for Sean and Gareth. And then we can decide whether it's a good thing or not. So first of all then, business asset rollover relief to kick off with. Again, just remove me for a second. Let's talk about this. This is where you're effectively rolling over the capital gains tax liability. So what's happening here is that you delay paying the capital gains tax because you want to dispose of your holiday let property. You want to sell it. So you don't pay capital gains tax on the sale of the property. What happens is you use the proceeds to buy a new holiday let. So the 400 grand that the guys make, they could then use to buy a new holiday let. And then they delay the tax until you sell the new asset. Makes sense, doesn't it? You're rolling it over. So the eligibility, you pay the tax on the gain from the original asset, of course, but you must buy the new asset within 3 years. That's just the basic rules, which makes sense. You think about it, because you're in the business of buying to sell to buy another holiday let, a bigger one maybe. You're using all the proceeds you made from the first property to buy the second one. You're not paying CGT. You're just rolling it over to when you eventually sell the next property, because you're a business, and that's the whole point behind property relief. So that's one option available to the guys if they wanted to do that. But they're not actually buying another holiday let or eligible property or asset. They're actually using the money to go and have a good time in Las Vegas or something. Doesn't matter. But they're not utilising the eligibility here. So the one they will use then is the business asset disposal relief. This, of course, is where they're going to dispose of the asset as well. They're going to just sell it and move on. So what are the rules here? Well, first of all, business asset disposal relief is previously known as entrepreneur's relief. That's just the Prince and the Revolution thing there for you. You pay less capital gains tax when you sell the business. You actually pay tax at 10%. Not a lot of people know this, but only if you're a sole trader, partner, and you've owned the business for at least 2 years, which of course Gareth and Sean have, because just to pick up on the figures over here, they inherited the property in 2019, that's when they owned it, and they're selling it in 24, so they've owned it within that required period. So effectively, therefore, they can sell it, make a profit, and pay capital gains tax on it at a lower rate of 10%, which is a good thing, because they're going to be high rate taxpayers, aren't they? So that's the ruling. So how does that segue across then to the numbers then? Let's take a look at some numbers for you. Let's see if we can get this right for you. So what is the CGT chargeable gain then, and how much tax is going to be paid? Well, the chargeable gain then, if you remember from your capital gains tax, is where you work out how much of the gain in the property is going to be liable to CGT. So first of all, you've got your sale price of 400,000, which is fine and dandy. We're going to be selling the property for 400. Of course, you've got the costs of the sale. In other words, the estate agency fees and things you can offset against the figure as well. You've got the acquisition value. In other words, what it was worth when they inherited the property. Let's pop it back away. You've got that as well, which comes off. So we're getting the gain, aren't we? You think about it. Don't forget the improvements that the guy made. Not maintenance, but the improvements to the property, which is 50 grand, which then gives me a chargeable gain of £145,000, which is it's just a rough figure, isn't it? But that gives you how much potential capital gain there's going to be. Again, if we're into our numbers, which we are, business asset disposal relief, BADR, capital gains tax calculation for you. The taxable gain is 145,000, so we're okay with that, aren't we? The exempt amount, let's get that out of the way. The annual exempt amount for the year, and we're looking at 23-24, they get £6,000 annual exemption each. It's jointly owned. That's changing. We'll talk about that in a second. So there's a little bit of reduction in that. So that reduces the taxable amount to 133,000. I think we get that from capital gains, don't we? So CGT then of 13,300, which is 133,000 times 10%, due in 10 days' time. So that's the reduction. They saved themselves quite a bit of capital gains tax there on that one. Obviously, they would have not liked to have paid it at all. But any second property that you own incurs capital gains tax. It has to be paid. It's the law. But at least this reduces it because it was a business. Now that's a brilliant thing, isn't it? Because holiday lets are defined as a business. A normal buy-to-let with a short hold tenancy wouldn't be specified as a business, and that's the difference. So a lot of landlords selling normal properties, they have to pay the full capital gains tax. But that's all changing from the budget. Just to update you, again, we don't know the detail yet, but the 2024 spring budget changes for you. Well, first of all, the furnished holiday let regime tax benefits have been abolished from April 25. So the ability to offset all the interest, they're going to make it similar to owning a normal vanilla buy-to-let mortgage property. That's what they're going to do. It's another year yet, so these people got a year to make some decisions on what to do. Be interesting to see what will happen to the holiday let marketplace, whether we'll see a deluge of properties being sold. I don't know. There's nothing to stop holiday owner converting into an SPV. Obviously there's issues around capital gains tax, but you could roll it over, couldn't you, and put it into a special purpose vehicle, which many landlords are doing anyway, and that way you'd be able to enjoy a lot more tax benefits. It's a business, you should have a limited company anyway, I think, truth be told. So I think that's probably what will happen. So lots of accountants will make lots of fees from all of this, won't they? But again, the detail, nobody really knows what's going to go on yet, do they? What is sure, though, is that capital gains tax for higher rate taxpayers is now being reduced to 24%. Now think about that. This is for anybody who owns a second property. A high rate taxpayer would normally have to have paid the 20% for high rate taxpayers plus the 8% property bit. So normally they would be paying 28%. So I know he's let them off a few percent, hasn't he? Which is nice. Which is lovely. The annual exemption of capital gains tax is going down anyway in 24-25 to 3,000. So I think one just offsets the other, doesn't it, really? It's given you a few extra percentage or reduction in the rate, but he's actually reducing the annual exemption anyway. So I think the figures will probably work out pretty much the same. So that's the situation for you. It's all changed, isn't it? Now, I don't know if that's your marketplace, but as a mortgage advisor, mortgage broker, mortgage specialist, expert, property person, you should know about these things. You can have a conversation, can't you? Particularly the capital gains tax. This 24% change might be something your landlord clients might be thinking about. Maybe they want to sell one or two of their properties and they're not in an SPV. Maybe they want to sell it and put it into an SPV. So you might be able to get around to looking at possibly some rollover, but it's not a business, you see, buy-to-let individual landlords, unless they're a limited company. So get a good accountant is the key. I mean, as a mortgage broker, mortgage advisor, you give advice, but you're not an accountant. You don't deep dive into that sort of thing. I hope it doesn't change the holiday marketplace, but I do have empathy for people who live in the area. When we went to Porthleven, we stayed there for 2 weeks, there are dividing areas in that town. The people that live there and work there and contribute to the economy, they don't live around the harbour area, with all the views. They live further up in the town where property is cheaper. And I don't know whether that's right or wrong, that's what they do. The properties around the harbour area and overlooking the sea are extortionate prices, hundreds of thousands of pounds. You can see why they've been priced out. And in some towns and villages like your St Ives or your Polperros and places, every property is just stupidly expensive. And people that work there, staff that work in the restaurants and the bars and the fishing guys and all that sort of thing, it's just wrong that they can't live locally because they're being priced out. And they're trying to change that, you see, by doing this. I don't know if it'll work. I think there's a bit more to it than that. But that's a nice little update for you. Hope that's been useful. Bye.